In my last video, we learned about the stochastic oscillator, which is an indicator that helps us gauge momentum in the market. Today I'm going to be talking about Bollinger Bands, which is an indicator that helps us gauge the volatility of the market as well as how high or low prices are relative to their historical price action. So let's get started. So Bollinger Bands are comprised of three bands, which are referred to as the upper band, the lower band, and the center band. The center band is a simple moving average, which is normally set at 20 periods, and the upper and lower band represent chart points, which are 2 standard deviations away from the moving average. Bollinger Bands are designed to traders a feel for what the volatility is in the market and how high or low prices are relative to the recent past. The basic premise of Bollinger Bands is that prices should normally fall within 2 standard deviations represented by the upper and lower band relative to the center moving average line. So if you're unfamiliar with what a standard deviation is, you can feel free to ask me or take a course in statistics or econometrics. Trend reversals often occur near the upper or lower bands, as the center line is a moving average represents the trend in the market. This line will also frequently act as support and resistance. So the first way that traders use this indicator to identify potential overbought and oversold places in the market is watching for places where it touches the upper and lower bands, and these bands tend to represent extreme. Some traders in the market use a close outside the upper and lower band as buy and sell signals, but the developer, Mr. Bollinger, suggested that should only be traded with confirmation of other indicators. So you should be confirming signals with more than one method, because prices may tend to hug the upper or lower bands, specifically in places of strong uptrends or downtrends. So because of this, selling the upper band to the lower band is a technique that, if you are going to use, is actually a pretty good technique if you use other indicators in range-bound markets, and that's what I'm going to be focusing on here. So here we got PowerShare Qs, which is the NASDAQ ETF. We have a range line and a trend. So you can see in the range market we had multiple touches of the upper and lower band. In the trend market, it was hugging the upper band for a good portion of that time. So with the trades set up here, we can look at buying and selling with a touch of the upper and lower band. A better method is to combine with another indicator, is what I've done with the RSI. So you can see down below, which I'll make another video on. So you can see a divergence here as price moves up to a new high, but RSI does not confirm. So that would be your sell point, and the buy point would be, or the close would be, when the market pulls back off the lower band, because in range-bound markets we anticipated that when a move that starts at one end of the extreme, the high band, is going to move all the way through to the low extreme, which is going to be the low band. So we don't want to get out of the trade before it's finished and lose potential profits. So you want to be in that trade. So you're going to want to wait for a pullback off the bottom Bollinger Band line. So let's look at a Bollinger Band contraction method. In general, after periods of low volatility in the market tends to rally rather significantly, because as you may know, periods where the market doesn't move that much up or down is an indication neither the bulls or the bears are winning. So when one side does win, the market does tend to move pretty dramatically, either up or down, whether in favor of the bears or the bulls. So low volatility is obviously represented by contracting Bollinger Bands, and high volatilities represented by wide Bollinger Bands. So you can see here that we have a contraction of a Bollinger Band, and then we have a break above the top Bollinger Band, meaning that the buyers have won out in the situation, and then we have a nice run up after that. So you want to be careful when you trade this strategy, because if you do trade this strategy, because a lot of traders say that the first break above or below the Bollinger Band line tends to be a fake out or false signal, and actually reverses and goes in the opposite direction. So a lot of traders will trade the second break to avoid getting faked out and pulled into a trade in the wrong direction. So let's look at chart pattern. Because the Bollinger Band is plotted on price, we can use it with other things. You should be able to identify a double top scenario, a divergence in our relative strength index, meaning that not only do we have a double top going up into the second double top, there was a loss of momentum compared to the first top. So you can also see the touch of the Bollinger Band there, and that represented a pretty good move down in the market after it. There's a few resources out there because Bollinger Bands are one of the most popular indicators. So if you want to trade or use this as an indicator, I'd recommend researching it some more. And remember that trading is risky. Nobody, certainly not me, can guarantee profits. You should design your own strategies and profits. Make sure you do your homework before you get into the market, and that you're only trading with risk capital and money that only fits into your investment profile.